Welcome to this special session on monetary policy insights. I want to just caution you that this is all going to be live streamed, including the Q&A at the end. So any questions you ask will be on the live stream, but that's a ways off now. This session features a speech by Maurice Daly, President and CEO of the San Francisco Fed. The influential central bank governor Montague Norman, who led the Bank of England between 1920 and 1944, famously advised central bankers to, quote, never excuse, never explain. In turn, John Maynard Keynes described Lord Norman as, quote, always absolutely charming, always absolutely wrong. Indeed, central banking around the world has moved far from Norman's model over the last couple of decades, and Mary will describe current best practice and its rationale in her speech today on dynamic central bank communication. Mary is a very old friend of the WEAI, having served as its secretary-treasurer, and we're thrilled to be able to host her today. She was previously the director of research at the San Francisco Fed, became president in 2018, and her research is focused on labor markets, inequality, and the linkages between the macroeconomy and microeconomic outcomes. We also have two fantastic discussants for Mary's lecture who will bring both academic and market perspectives, and they'll be coming up to discuss after the main speech. Emi Nakamura is Chancellor's Professor of Economics at UC Berkeley, co-director of the Monetary Economics Program at the National Bureau of Economic Research. She previously taught at Columbia University. She was the 2019 winner of the John Bates Clark Medal of the American Economic Association, which is awarded annually to the best economist under the age of 40. She serves on the Congressional Budget Office panel of economic advisors and has also served on the San Francisco Fed's academic advisory panel. Our second discussant is Ellen Zentner. She's managing director and chief U.S. economist at Morgan Stanley. Ellen actually has deep roots in this western part of the country, having studied at the University of Colorado at Denver, and started her career as a senior economist in the office of the Texas State Controller. She went east to work at the Bank of Tokyo Mitsubishi and Nomura Securities before moving to Morgan Stanley. She's been president of the New York Association for Business Economics, is on the advisory boards of the New York Fed and the Chicago Fed, among other public service roles. It's my pleasure now to turn the podium over to President Daly, after which we'll hear reactions from Emi and Ellen. Okay. Thank you.
Well, thank you very much, and it's just a complete delight to be here. And an honor to be speaking. I looked it up at the WEAI 100th Annual Conference. That's quite a testament. It's a milestone, actually, to the enduring contributions of economic research that the association has made. So well done and happy anniversary for those who follow such dates. Now, when Maurice first invited me to speak, I thought of many topics worthy of focus. But one rose above all others, perhaps because it's perennial, and that is central bank communication. As researchers and educators, you understand the importance of communicating. It's a large part of your jobs. But for central bankers, as Maurice highlighted, this value has been harder to recognize. It's even been doubted. Communication has always come with questions. Should we communicate? How often? And what should we say? Now, on the question of should, my answer is simple. Absolutely. Public institutions have an unequivocal obligation to share information, and central banks are no exception. It is a duty of public service to be transparent about and accountable for our actions. But this itself is not a license to reflexively do more and more. Communication is also a responsibility, and it comes with an imperative to improve understanding. How to balance these objectives is the topic of my remarks today, and I look forward to a very active discussion. But before I go any further, and if you've heard me speak, you know what's coming, I would like to remind you that the views I express today are my own and do not necessarily reflect my FOMC colleagues or anyone else in the Federal Reserve System. I also want to emphasize that today I'll be speaking broadly about central bank communication, and my remarks are not about the ongoing framework review at the FOMC. Now, to understand where central banks might go on communication in the future, it's very useful to know where they've been. And here I will narrow my focus to the Federal Reserve and to the FOMC. For most of its history, the FOMC has worked under a veil of secrecy. And this was intentional. Federal Reserve officials were either silent or purposely vague, letting financial markets learn about policies through inference by watching movements in market interest rates. The prevailing view at that time was that less transparency promoted candid internal debate, minimized disruptive financial market reactions, and provided flexibility to respond to unexpected events. And many policymakers at the time thought that they needed to surprise markets to have an effect. Today, the Federal Reserve is significantly more transparent, an evolution that has taken place over the last 30 years. So we started in 1913, and the evolution began 30 years ago. And this timeline tells you the story. It's over there and over there. The FOMC now publishes meeting statements and minutes, economic projections and projected interest rate paths, a statement of longer-run goals and monetary policy strategy, and of course, an explicit inflation target. The chair also holds post-meeting press conferences, and FOMC participants like myself regularly provide their own commentary and views during the intermeeting periods. These enhanced communications have had considerable benefits. First, they have increased the public's understanding of the Federal Reserve's mandates and commitments. Second, as research has long documented, clear monetary policy communication has helped anchor inflation expectations and help the FOMC navigate economic shocks more effectively. Finally, these communications have allowed households, businesses, and financial markets to understand how policymakers see the economy and how they might react if things evolve differently than expected. And ultimately, this has improved their ability, especially households and businesses, to make better decisions. If you take the last 30 years collectively, this increased communication has improved transparency, credibility, and accountability, all of which have helped build trust. Now, given this success, many have asked if we should do more. And academics and analysts, market analysts, and policymakers have offered a variety of suggestions about what we might do. The ideas range from publishing details, a lot of details about the forecasts and the risks, to doing scenario analysis, to simply simplifying the message and using social media to build understanding. But the question is, as we think about choosing, how should we balance the need for transparency with the responsibility of improving understanding? And to answer this question, I return to two periods of history. So let me start with the global financial crisis. As you likely recall, the recovery from the recession was painfully slow. Then Chairman Ben Bernanke and others grappled with how to implement monetary policy that was constrained by the zero lower bound on interest rates. Borrowing from a long academic research, they implemented a variety of alternative tools. And this helped guide policy expectations towards a more accommodative stance, which ultimately helped support the recovery. These very detailed and definitive communications made sense. After all, inflation was below target, employment growth was weak, and markets weren't sure at all about how long the FOMC would be accommodative. In fact, markets regularly assumed that interest rates would rise faster, lift off earlier and rise faster than FOMC participants expected. The definitive communications made the policy path clear and offered the support the economy needed to move back toward the dual mandate goals. So now let's roll forward about a decade later. The pandemic hit. Economic activity plummeted and financial markets teetered. The Federal Reserve cut interest rates close to zero and took emergency steps to support the flow of credit and liquidity. We committed to using the full range of our tools until the crisis had passed and the economic recovery was well underway. Notably, that included a commitment to keep interest rates near zero until we were confident that the economy was on track to achieve our employment and price stability goals. And we were very specific in our guidance, following what we had learned in the global financial crisis. Our policies and our communications helped stabilize markets, threw a lifeline to businesses and households, and put the economy on a quicker path to recovery. And this all worked until it didn't. You know what happened. In 2021, inflation surged and we needed to pivot. We raised rates aggressively and communicated strongly that we were resolute to restore price stability. And these efforts have been largely successful. Inflation is now near our 2% goal. But looking back, it could have been easier, especially on the people we serve. Our strong forward guidance in the aftermath of the pandemic firmly set public expectations. But then, when the economy shifted and inflation soared, it left people uncertain about how we would respond. While there were many drivers of the global run-up in inflation and the subsequent rise in inflation expectations, our guidance likely didn't help, at least initially. The lesson for me from that period is that being definitive in highly uncertain times comes with a price. And we need to evaluate that price as we make future decisions about what to say and how to say it. Words have power, which is a great tool, but they can be harder to reverse than the interest rate. They set expectations, which can be hard to change in the event that the economy evolves differently than we expect. So what do these two periods of history tell us? Mostly this: there is no single simple answer. Effective communication requires a dynamic approach and continuous evaluation. What works in one situation may not work as effectively in another. Communication must be consistent enough that people can follow, but dynamic enough that it can adjust to the circumstances we face. So then how should we choose when and what to do? For this, I look to principles. The first principle is clarity. Anything we do should improve the public's understanding of our goals, expectations, risks, or reaction function. We should always have a purpose for communicating and a way to evaluate our effectiveness. Second, any communication should enhance transparency, revealing how we think, how we make decisions, and why we reach the conclusions we do. This is the foundation of accountability. The final principle is flexibility. The economy is dynamic, and our communications must match it, providing guidance about what we know, humility about what we don't, and a commitment to respond to the world we get, even if it is different from the one we expect. Now, like many things in life, these principles can come into tension at points in time. And then central banks will have to balance the trade-offs. And in those moments, we need to return to why we do this at all, why we speak, why we communicate, to be open and accountable to the public we serve. Now, I started at the Fed in 1996 in the research department. I quickly learned that we were an institution that did a lot and said very little. But that didn't always serve the public, so we changed. Our journey cannot stop here. Public institutions like the Federal Reserve have a responsibility to continually revisit how we communicate and how we can do it better. It's not only the right thing to do, as history has taught us, it's the best thing to do. And with that, I'd like to turn it over to Emi and Ellen, and I thank you in advance for the discussion.
Okay, so you're going to move that? I think so, yeah. And I think you're going to start. Yeah.
Okay. Well, thank you very much, Mary, for those incredibly interesting remarks on what is both a topical and a timeless topic. There were two main parts of Mary's speech. The first was about the history of Fed communication. And here, what Mary drew out was that for much of the Fed's history, the Fed actually prided itself in working under a veil of secrecy. There were lots of reasons for this, more internal candor, less financial disruption, and the belief that you actually needed to surprise financial markets in order to have an impact. But she also discussed just how much things have changed over the past 30 years, with the Fed going from working under this veil of secrecy to publishing an incredible array of things ranging from just the statement to the minutes to dot plots and so much more. So let me start by saying that I completely agree with Mary's perspective that this evolution of Fed views from really priding itself on the cloak and dagger to almost exactly the opposite, a 180-degree turn to emphasizing transparency and, in fact, the importance of calling your shots like a pool player so that you can implement forward guidance is one of the most remarkable transformations in the conduct of monetary policy over the past 50 years. And a lot of this triumph in the conduct of monetary policy, and this is sort of what's so exciting about talking about this at a place like this, really dovetailed with changes in the academic world and in intellectual views on monetary policy. Because 50 years ago, there was also a prevailing view in the academic world that the larger the announcement effect of monetary policy on financial markets, the larger the impact of monetary policy. So in other words, the view was that if you didn't surprise markets, the monetary policy wasn't doing anything. And that has transformed into almost exactly the opposite view, that in fact calling your shots, giving a sense in advance of what you're going to do with monetary policy in the future, by affecting longer-term interest rates can in fact be an incredibly powerful tool for affecting the real economy. So just this remarkable transformation from thinking that you have to surprise markets and be very secretive to thinking that transparency can be one of your most powerful tools. In the academic literature, there was actually a time when academics thought, in what is now called the literature on high-frequency identification, that if you didn't see a response of financial markets at the time of an FOMC announcement, that indicated that monetary policy actually did nothing. And I think what the literature has realized by now is that this was really a big confusion, that it could mean exactly the opposite. It could mean that what had happened was that Fed communication had really prepared the ground for what the Fed was going to do later, and that the fact that there was no impact at the time of the announcement was in some sense showing the power of the Fed's words and the transparency at an earlier point in time. There's a famous example in a paper by Gurkainak, Sack, and Swanson of exactly this kind of an episode, where on January 28, 2004, the Fed removed the statement, which had been there persistently, that policy accommodation can be maintained for a considerable period. And there was no change in that meeting in the Fed funds rate. But nevertheless, longer-term bond yields jumped by 20 to 25 basis points, one of the largest changes in recent years. And all of this was because of this change in the statement. And what this indicated was exactly this power of the Fed's words, and not just their actions, in shaping not just market outcomes, but of course these are the longer-term interest rates that feed into mortgages and lots of other things that matter for the economy. So these changing ideas about transparency in the academic literature have also dovetailed with dramatic changes in the nature of Fed communication in public policy, as Mary said. So if we start by looking at the statements, in terms of words, under Greenspan, they were only 100 to 200 words, so actually quite short. Under Bernanke, this rose to often more than 500 words. Under Yellen, sometimes the statements were as long as 700 words. So really a dramatic increase from the times of Alan Greenspan. And this trend has somewhat been reversed under Jay Powell. Another example is the Fed minutes, where again, there's been this remarkable increase in transparency, and academic researchers have actually studied the consequences of this increase in transparency. So there's this really interesting natural experiment that the Fed minutes actually were always being tape recorded, and the participants at the FOMC thought that this was something that was destroyed after they were, the minutes were prepared. But in fact, Alan Greenspan later revealed that no, these minutes had been archived and transcribed, and the Fed actually agreed to publish these transcripts going into the past, but also into the future with a 5-year lag. And so researchers have been able to look at this to understand what the impact was of the transparency on the actual discussions that were going on at the FOMC. And what they found out is that, perhaps not surprisingly, making the transcripts public made the discussions less interactive, more scripted, and more quantitative. And all of those things, of course, come with both costs and benefits. The second thing that Mary reflected on in her speech was the experience of the post-COVID inflation and what she thinks that the Fed could and should learn from that experience. She reflected on the fact that the Fed promised to keep interest rates near zero until we were confident that the economy had weathered the storm and was on track to achieve our maximum employment and price stability goals. And she talks about how she regrets that perhaps they were too definitive about their guidance, because COVID was just such an incredibly unusual event. And that perhaps these statements were not sufficiently reflective of the amount of conditionality that was warranted in view of the incredibly unusual situation that the Fed was in. And in the end, she says that she regrets that this, in certain ways, made it hard for policymakers to later change their minds about what they wanted to do with policy. Ultimately, Mary says that she's walked away from this experience believing in 3 key principles: clarity, transparency, and flexibility. And I'm very sympathetic to these ideas. To the first on clarity, I would add additionally the principle of truthfulness. Because there are times when there is a temptation for the Fed to be less than truthful on inflation, to affect people's expectations about where inflation is going, can impact inflation today. So there's an obvious incentive to try to push things in the direction of things being rosier than they actually are. And the same is true in a recession. But it's crucial for the Fed to remain truthful, to maintain a reputation for being truthful. Because as we've discussed, the Fed's words really have a big impact on financial markets. And that impact is predicated on the view that the Fed is really doing its best to call it how it sees it about the economic situation. On transparency, one of the things I thought was really interesting is that the transparency Mary is talking about is not exactly this old transparency, this old version of transparency that I talked about at the beginning. It's actually closer to conditionality and really dovetails with her points about flexibility. The idea is that the Fed needs to be flexible, and it needs to be clear about the fact that it is flexible. It needs to avoid tying itself to the mast of policies that will later be inappropriate. And I think this is a really important idea. One of the things that I wanted to emphasize is that sometimes in response to this kind of an argument, people will say, well, once you start making conditional promises, maybe you're not saying anything at all. Maybe you can't benefit anymore from forward guidance in the way that I have discussed academics and policymakers have emphasized over the past decades. But I really think that's a false dichotomy. Just because you say that your policy might change, if the economic situation changes dramatically, doesn't mean that you can't promise anything at all. It simply means that you're giving yourself sort of an escape clause for really important changes that might occur in the economy. And of course, looking at COVID, this was a case where we were going through a recession unlike any that we had ever seen in the past. And so, I think as Mary emphasized, some degree of being humble about what we could predict was important. On this last point, I think one of the things that's interesting to note is that if you look at the Fed's statements from the post-COVID inflation surge, they actually did include some escape clauses. So the typical statement in 2022 said something like, the committee will aim to achieve inflation at or moderately above 2% for some time. But the committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. So I would emphasize two things. One is aim to achieve inflation at or moderately above 2%. So moderately above 2%, at least the way I would read it, doesn't mean 5%, for example. Second of all, the committee would be prepared to adjust the stance of monetary policy if risks emerge that impede the attainment of the committee's goals, i.e. the whole 2% thing, or roughly around 2%. So what I want to emphasize is I actually think that those statements in the lead up, to the COVID, post-COVID inflation surge, they really did include some escape clauses, maybe a little bit more conditionality than was appreciated by all the readers. And yet, later on, when Fed governors spoke about, about the mistakes they had made, one of the ideas was that they felt hamstrung by their previous promises not to raise interest rates. And I just want to emphasize that, if you read the words, it actually wasn't an unconditional promise. And so I think one of the important questions is, to what extent is it about the right statements, and to what extent is it for the Fed to feel comfortable using some of these escape clauses, when they're there? Those are some of the complexities of how communication works. So lastly, let me say that in thinking about communication, Mary emphasizes both the sensitivity of financial markets to Fed actions and the sensitivity of the Fed to the financial market sensitivity to Fed actions. And I think it's crucial for the Fed to acknowledge that in serving the goals of clarity, truthfulness, and transparency that Mary emphasizes, and I agree these are very good principles, the Fed needs to stand ready to sometimes surprise markets. It shouldn't try to surprise markets, of course. Aiming for transparency is important. But there are times when the situation changes. And in view of this changing economic situation, good policy has to change too. This is something where the Fed's learning curve has been very difficult. The taper tantrum was a very difficult episode to go through. But nevertheless, while that was a difficult episode on one side, to some extent, the challenges involved in pivoting to raising interest rates in the post-COVID inflation were perhaps also exacerbated by worries in the other direction of too big a surprise to financial markets. So I think finding the right balance there is also a crucial aspect of practically being able to implement these three principles that Mary emphasizes. Thank you.
Now we can do. Okay, we'll do a little bit of construction here on stage. Mary, we're moving your box. Okay, here we are. While I get my iPad set up, since this is live streamed, Mari, I have to do a little bit of correction on my bio because Michael Gapin, the current chief U.S. economist at Morgan Stanley, might be upset that I was named as chief U.S. economist. So I was chief U.S. economist for about 11 years, and now I'm chief economic strategist. So there's a huge difference. I've also rotated off the advisory boards quite some time ago for New York Fed and Chicago Fed. So I did my time, and I'm now on the Treasury Borrowing Advisory Committee, though advising Treasury with my Committee on Technical Debt Issues. So a lot has changed, and onward and upward. All right, so let's get started. I want to thank Mari, you, for inviting me to participate in the panel. It's an honor to share the stage with President Daly, with Emi Nakamura, and be able to comment on the speech that Mary delivered today. So my remarks today come from a practitioner standpoint, the practice of Fed watching. So I've been a full-time Fed watcher for more than 25 years. So I have seen a lot of changes in the way the Fed communicates over time. President Daly's paper, Dynamic Central Bank Communication, addresses the evolution and importance of clear, effective communication by central banks, particularly focusing on the Federal Reserve. She emphasizes transparency, accountability, and flexibility in communicating policy decisions. President Daly provides historical examples, notably during the Great Financial Crisis and the COVID-19 pandemic, highlighting successes and shortfalls in central bank communication. She then concludes that communication must remain dynamic and context-dependent to effectively navigate rapidly changing economic conditions. My team of economists at Morgan Stanley skews much younger than myself, and therefore most have only practiced in the current environment of transparency. Imagine their surprise to learn that prior to 1994, interpreting Fed policy relied heavily on market inference rather than explicit communication. Even prior to each meeting, traders would famously watch closely for subtle clues, including in which hand Chairman Greenspan carried his briefcase. Traders believed that a briefcase carried in the right hand indicated a policy change. The left hand indicated, no policy change was the right hand. The left hand indicated a likely change. Financial markets do not handle vagueness well, and this example underscores that lack of communication was leading traders to grasp at even the shortest straws. It may surprise you little to learn that the briefcase indicator was not a reliable predictor of monetary policy outcomes. Any accuracy was likely a coincidence. At the time, the standard practice was the next morning, one had to go to the newspapers and watch markets and watch short-term interest rates, particularly the federal funds rate, since the Fed implemented policy through open market operations. 2, you also had to analyze open market operations themselves. Market participants closely monitored Fed activities and securities markets to deduce its intentions. And finally, you had to follow interbank lending rates. Changes in rates banks charged each other indicated the Fed's policy stance. So that was quite a bit of lag between the time of the meeting and the time that you could fully understand what is it that the Fed just did. So the timeline provided in the figure shown by President Daly reveals how the Fed has transitioned from secrecy to significant transparency, including detailed statements, economic projections, and regular public commentary. These changes have been well proven to be helpful in fostering a greater degree of financial stability, though it has also fostered new obsessions for market participants who quickly shifted to putting too much weight on the accuracy of the Fed's projections, creating new communication challenges for the central bank. Judging from my conversations with investors and colleagues, it's taken some time, spanning 3 Federal Reserve chairs, to get financial market participants to understand the degree of uncertainty around its projections. Holding a press conference after every meeting of the Federal Open Market Committee, as Chair Powell initiated in 2019, helped to hammer home that message, but it remains a work in progress. Increased clarity has also anchored inflation expectations, reduced investor uncertainty, and fostered trust and accountability, especially in times of stress. President Daly makes an important conclusion. There are also challenges and risks that can arise from overly definitive forward guidance during periods of high uncertainty. The central bank could set firm expectations that become difficult to adjust, potentially complicating responses should economic conditions shift rapidly. Instead, the Fed should maintain flexibility, clearly communicate uncertainties, and regularly reassess and adjust its communication strategies. So the Fed's communications will continue to evolve. Now, the Federal Reserve reviews its monetary policy framework every 5 years. The most recent review concluded in August 2020, resulted in the adoption of flexible average inflation targeting, or FATE. Though Vice Chair Clarida at the time called it evolution, not revolution, the change was significant and ultimately unknowingly addressed yesterday's problems, namely the persistence of below target inflation. At its core, the goal was to achieve an average of 2% inflation over some unspecified period of time. Over the course of the business cycle, for example, following a period of below target inflation, the Fed would need to implement policy in a way that encouraged above target inflation for a time such that an average 2% was achieved. With the absence of an agreed look-back period, the framework was too vague. And vague is not the same as flexible. It seemed from the get-go fate was ill-fated. The world changed with the onset of the COVID-19 pandemic. Inflation soared and has remained persistently higher than goal. Tariffs now threaten to send inflation higher still, and international conflict has led to a spike in oil prices, though we can't know if that will be sustained. Though the great debate since COVID and the rise of a multipolar world has centered around whether or not inflation is structurally higher, the FATE framework today would argue that the Fed should implement policy that leads to sustained below target inflation, and inflation would need to stay there, well below, for a prolonged period of time. Before COVID-19, inflation was consistently below the Federal Reserve's 2% goal for roughly a decade. My guess is that participants on the FOMC do not want to return to that environment. Finally, I don't believe a consensus of FOMC participants would agree that today's monetary policy stance is consistent with the FATE framework, but I welcome Mary's pushback in that belief. President Daly concluded her speech that the Fed's communication strategy is not static and needs to evolve alongside a changing economic landscape. It's amazing that 5 years has already passed since the 2020 framework review. The Fed's next framework review is underway and will conclude later this summer. The review includes its strategies, tools, and communications. My own expectation at this early stage is that the Fed replaces flexible average inflation targeting with a simpler framework that harkens back to a period under Chair Yellen when the Fed expressed that it would be equally dissatisfied with inflation persistently below goal as above. It is simple, flexible, works in any structural regime, and it is not time dependent. In the press conference following the June FOMC meeting, Chair Powell stated that a review of the Fed's communications also includes the summary of economic projections. As President Daly noted, suggestions include publishing a single baseline forecast as well as alternative scenarios. I imagine getting 19 participants to agree on a single baseline forecast will call for adding another day to the FOMC meetings, and you still may not come up with an agreed answer. Providing alternative forecast scenarios is standard practice for the research division of each regional Federal Reserve Bank. Many market participants are unaware that the Federal Reserve staff also produce alternative scenarios. Providing alternatives is commonplace for professional forecasters as well. Scenario analyses provide clear frameworks to understand potential policy reactions and prepare investors for various outcomes. So one might say, what's the big deal? The Fed staff surveys FOMC participants ahead of the quarterly SEP meetings and can simply revise the survey to add space to submit alternatives. But would the alternatives be presented in the same format as current projections? The current SEP presents the median of the mode of 19 different participants. Would the Fed then add the median of the mode for alternative scenarios? What are the drivers of those alternative scenarios? Does the Fed staff provide the assumptions to the regional banks for modeling? My guess is that providing both a single baseline forecast as well as alternative scenarios is easier said than done. I appreciate Gordonachenko, Pham, and Talavera's proposal of greater use of social media, as President Daly referenced in her speech. It can broaden the central bank's reach to the general public, provide more timely updates, and clarify any misunderstandings in real time. This seems like an easy lift to me that complements the Fed's communication strategy. Though I have to say, I'm not a fan of social media, but that's probably just my old fogeyism peeking through. The increase in transparency over time has a proven track record of success. Fed communication is the first line of defense, especially in periods of heightened uncertainty. The Fed's communication strategy will continue to evolve. President Daly said that effective communication needs more granularity. I look forward to the results of the framework review later this summer and playing my part as translator to financial market participants. Thank you, and I welcome the discussion to follow. Mari, what chair do you want me in? Okay.
I'm supposed to be here. Are you going there?
Oh, I don't know. Go ahead.
They told me to sit here.
Great.
I'm going to sit where they told me. Is this where you want me?
This is great.
Okay, perfect.
Okay, thank you, Mary, for your speech and for the discussions. These were all great contributions. And I want to first give Mary a chance to respond to anything the discussant said, and then I'll sort of open it up for some discussion, more discussion among ourselves. But
Yeah, let me start with, thank you for the time. Let me start by saying I appreciated both discussions, and there's so much I could talk about, but Emi, I want to say that I really like the addition of truthfulness. I think we have done that, we've leaned into that a bit. The point that stands out to me is when Chair Powell at his press conference said there might be some economic pain as we bring inflation down, and there were people who said, wow, he's saying this. And I said, but it's better to tell people than to pretend it's not going to happen only to find that it did, right? I'd rather err on the side of being open about what we're willing to tolerate than hiding that and then you have to explain it later. So I think that's a really nice addition to the principles I've laid out. The second thing I'll say is that on the piece of the escape clauses, so I've learned something valuable. I don't know if anybody in this room will agree, but I'm guessing you will. So when my wife asks me, what time will you be home? And I say 6, unless something happens, she only focuses on the 6. And she doesn't actually, I don't have a good get out of jail free card when I say unless something else happens. And I think the same thing can be applied to just how we communicate in general. If you say unless something happens, then people focus on the thing that's at the top. And that's why I think some of the suggestions about scenario analysis and other things have come up, because we really need to communicate that there's a range of outcomes. So, but thank you for the discussion. It was really great. Ellen, similarly, thank you for the discussion. It was terrific. I mean, I'm always conscious of the fact that there are people like yourself who have spent their entire careers translating what we say into how people should think about it. And one of the things that I've thought about a lot is about this interaction between financial market sensitivity and how sensitive we are to it. You know, what I feel encouraged about is that we have departed from a little bit in the post-COVID world, from the idea that if we haven't told markets already, we shouldn't do it. And the 75 basis point increase on a regular basis was the first surprise in a long time, really. And so I think of that as a helpful thing. I'd be curious to know how you think about it. The second thing that I think about is that there's so many things that one could do to communicate more effectively, so many proposals out there. And that's why I always bring it back to what is the problem we're trying to solve and what is the audience we're trying to reach. Because otherwise you just take everything, and then again, I'm going to use another analogy or metaphor. So if you've ever got those health updates from your physician when you get a test, even a normal test, if they update you every day saying your test is not ready yet, and they do that for 5 days in a row, anxiety goes up. It's only when they say, we're working on your test, it'll be here at this point in time, that people feel better. So I want to make sure that as we evaluate things we might do, that we're not over-communicating to make ourselves feel more transparent, only to find that the information that we're giving the public has been anxiety increasing and information reducing, as opposed to clearer and more transparent. But thank you both for excellent discussions. I'll take a lot away from those.
okay, Emi, Ellen, any reactions?
I think for me, I think it was around in 2018 or so, as we were going through balance sheet reduction. If I remember correctly, it was around that time that Chair Powell and the committee began talking about, we're going to give people a long heads up. It was shown in the minutes that there was discussion and broad agreement that any changes to policy should come with a long heads up. And I do think that was hugely helpful, because it helped baby step financial markets toward what was to come. And so then you would get a gradual repricing of what could happen. rather than a sudden repricing. And so it's interesting that you brought up the, switching to the 75 basis points. It was sort of an oh my God moment because we didn't get the long heads up. And so then but when you have to, when things change that quickly, as inflation did during COVID, you also have to pivot quickly. So I'm not sure that would, I certainly didn't take an example of the Fed has now abandoned this sort of idea that you want to give long heads up. I think it did lead to some of the angst around, in 2022 it was, that's it, recession is coming. How can the Fed be so aggressive without killing the economy? And there were many reasons that we argued at the time that we were more interest rate insensitive. But I certainly don't think markets have assumed that because of that example that you gave that there's not going to be sort of heads up to policy changes. And you've continued to do that with the incremental changes in the balance sheet that we've made.
Yeah, I took Emi's point, and you can tell me if this was wrong, but that, if policy has to do the right thing, and it surprises markets because the right thing is more important than the communication, then we have to do it. And I think that's just a piece of evidence that I would point to. But that doesn't mean that it's an optimal policy to never communicate and always surprise. I think we've learned that lesson from long ago. So both can be true, and that it reflects the complexity of the world we live in and how central bank communication can never just be one thing. It has to be a variety of things. Ultimately, just to put a finer point on this, anchored in the right policy decisions. That's the most important thing, right? We make the policy for the people we serve and the economy we've been tasked with supporting, which is full employment, price stability. We can never abandon the right thing to do for fear we haven't told anyone yet.
Okay. Let me start off with a question for, in the first instance, Mary, but also for the group to respond to. We're obviously in a very difficult policy environment now, and it strikes me that it's also a particularly difficult one for Fed communications. In a world where you have inflationary pressures because of excessive demand, theory tells us there's a divine coincidence, and things are easy. You reduce the demand pressures, you return to the natural rate, you get inflation to target. But that's not the world we're in, and in particular, we're thinking about an institution which, unlike some central banks, has an explicit dual mandate. It's not just about the price target, although the Fed, in its communications, talks about the price target quite a bit. So with all of the uncertainty about tariffs and the likely pass-through coming to prices, there's an inflationary shock on the horizon. But at the same time, the tariffs and the uncertainty around them are certainly contractionary. And so somehow the Fed has to communicate to the public why it is doing what it's doing in terms of its dual mandate. To make things even more complicated, there's a potentially large expansionary fiscal shock on the horizon. So, how does one sort of explain to the public in that context, that if there's a single target, it's easy. If there's a trade-off, you somehow are making your values known, or maybe need to make your values known to guide the public. So where do you come out on that?
Absolutely. So let me start by saying that communication is always more challenging in periods of uncertainty. I think about Ben Bernanke gave this famous speech to me on gradualism. And gradualism was not about communication, it was about policy decisions. And his point was that if you know exactly where you want to go, you can go quickly. And if you are uncertain, you should tread more carefully, because you can make mistakes by simply running to a place where you don't have certainty that that's what's evolving. I sort of take that same spirit back to communication. If we know what we want to say, it's very easy to say it with emphasis. If you're unsure about what you want to say, it's hard to be definitive in such an uncertainty. But that doesn't mean we can't communicate. And so here's where I fall back on this, and then I'll get to the trade-off question. I fall back to this point, that what the public seems to really want to know, and I get that from going all over the 12 districts. I have 9 states. I have a lot of sampling points here, where people really want to know not what's going to happen, but how we think about things. how do we think about how policy should move if one outcome occurs versus another outcome? And so let me give you an example. The way we speak to it is, or I speak to it, is we could have tariffs have an impact. That could have a delayed reaction with some persistence on inflation, because inflation expectations drift, et cetera. We could have a delayed impact with no persistence, and that would roll off, just be a one-time tax, if you will. The economy absorbs it, doesn't have a persistent impact on inflation. Or we could have less impact than any of our models in history would tell us. And that's because it could get absorbed throughout the economy in various ways. You have the tariff, but it comes out over time and takes out of profits, takes out of different importers, and no one really notices it, even though it's happening all over the economy. It still impacts the economy, but not in the ways we would traditionally see in our models. We have to keep all of those things in mind, and as we keep all of those things in mind, be in what I call the center position. I really like using metaphors when I'm out in talking to people. So if you've ever played a court sport, you want to be center court. It puts you in the best position to respond to one thing versus another. So you want policy to be in a good place, which I see it as now, and able to adjust across the range of things you think you can happen. Now that looks completely like scenarios, which I think it is. It's in one scenario we might do this, in another scenario we might do that, and I'm happy to talk about those. The question is, do you want to have actual scenario analysis, or do you just want to talk through scenarios? And many of my colleagues and I have gone out and talked about scenarios. Now, what do you do in the trade-off space? My own sense is, we balance the risks. If we think the balance of risks are to inflation moving up and a minor increase in the unemployment rate, well, then we might say, well, we want to focus a little more on inflation. If inflation and employment are roughly balanced in terms of the risks, which is how I see the world right now, we are at a point where further slowing in the labor market could turn into weakening. And if you study labor economics or you just know history, you know that once it starts to move in a negative direction, it shoots up sharply, and by then it's too late. So we have to keep our mind focused on that. And the other thing we have to keep our mind focused on is if inflation simply persists at above our target for a long, long time, the anchor could start to drift. I'm not seeing any evidence of that, so it just leads me to conclude that the balance of risks are roughly equal, and that we have to navigate policy not only depending on how the environment evolves, but also with keeping those two objectives in mind. And that makes it hard because we wouldn't be in the divine coincidence. I mean, central bankers across the globe long for the divine coincidence, where we have one tool in the United States, two explicit goals, and you have to accomplish both with one thing. The divine coincidence, it's easy. You have one tool, you move it one direction, both goals improve. In the space we're likely to be in now, we're going to get some pressure on inflation potentially, and some weakening in the labor market. Well, then you're balancing those two objectives. But for me, I think they're roughly balanced at this point. We would focus on both.
Okay. Anyone want to jump in?
Well, I think I would draw the parallel when you spoke about how unusual the post-COVID inflation was. Of course, that was the first time in decades that we had seen, double-digit inflation. So I think that this last period has also been historic in multiple ways. I mean, the changes in terms of tariffs and policy uncertainty are absolutely off the charts. So I think the messages in your speech about sort of being transparent about flexibility and some degree of state contingency are very reasonable in this situation. And it was very reassuring to hear what Ellen said, that the fact that the Fed had to make a change given, in the post-COVID inflation, given the crazy things that were happening that they didn't anticipate and that were very historic relative to prior experience, that markets, they understood that when you have huge changes, sometimes you can't give advance notice of everything you're going to do. So that, I think that's sort of reassuring. That
Yeah. I think for me, as I said, everyone does scenario analysis. if in the private sector, when we provide investors with the baseline forecast and then alternative scenarios around it, we are also providing a policy path for each of those scenarios. And that way, if an investor thinks that the economy is moving in the direction of one of those scenarios instead of the baseline, they can sort of choose which one they think that is and kind of adjust their own expectations. For the Fed, that's more challenging. And in your paper, you had noted Bernanke 2025, talking about all the central banks that are already providing alternative scenarios, but suggesting, because I think it was most of them did not also provide the policy path in those alternative scenarios, and suggested doing something like the same. And I'm not sure that would, providing alternative scenarios for the economic variables, but not the policy path associated with that alternative scenario, I'm not sure that it would add that much more information to markets, because the policy path in those scenarios would still be in question. You talked about the balance of risks, and when the Fed added the balance of risks and then moved it to be in the materials released at the time of the statement, because I think it used to be released in the minutes a few weeks later. As a practicing economist in the private sector, that was hugely helpful, being able to see among the 19 participants, how did the risks around their forecasts shift? And that's another intense focus of markets. Did one person now see, an additional person see upside risk to inflation? Did no more see? And I think that alone was a super important change that still provides a lot of information, because we can see how the balance shifts among the 19 participants each quarterly meeting.
Everyone likes microdata.
Yeah.
That's my mantra. Everyone likes microdata. I think one of the things that's really important is for everyone in the audience to know who might not follow the Fed as closely as Ellen and Emi do, is that essentially we already have scenario analysis as part of our regular practice. That's just being a good, central banker. Our teams, whether at the board or the reserve banks, think through these things. Many of us talk about it publicly, not just in this particular period of time, but in other periods of time. The question is, could we make it more uniform and put things out collectively? But I don't want you to walk away thinking that we don't do these things. It's simply about whether we should publicly do them and make them uniform across all the participants. That was former Chair Ben Bernanke's proposal.
Hey, let me ask about a different sort of communication problem, which relates to market functioning. So in April, as everyone will remember, after the announcement of the Liberation Day tariffs, there was a sharp uptick in Treasury yields, longer-term Treasury yields, and President Collins of the Boston Fed gave some reassuring comments to the markets. But there's sort of a general issue in that there have been problems in Treasury market functioning related to liquidity. There's a general issue of how much should the Fed intervene at times like that, and how to distinguish market functioning interventions from monetary policy. When the Bank of England intervened in 2022, it was engaged in QT, but then it suddenly had to apparently reverse course. And it seems like this is an issue that comes up not frequently, but could become a bigger issue. Of course, there are reforms of the Treasury market being raised, but how does the Fed approach that sort of issue and sort of financial stability issues in general?
Sure, would you like me to start, I suppose?
Yeah.
Okay, so let me just start with going to some broader principles. So, the way that I think it's important to think about this is there's a difference between monetary policy and the balance sheet, moving the balance sheet around for policy purposes, and market functioning. And intervening to stabilize dislocated markets. Now, they often correspond to each other because the economic shock both requires support, but it also requires some appropriate fixes for the dislocations. So the problem with the dislocations is that if you're in the markets, and I'm going to be bold here, you can correct me, but you don't like volatility, and volatility would, the natural thing is to have everybody, the Fed come in right away. But ultimately, the markets work themselves out. And that's something that actually is part of the resiliency in the system. There are all kinds of improvements, being considered and absolutely should be considered. We don't want the Treasury market to be vulnerable so that the Fed has to constantly intervene. I grew up in Missouri, and one of the constant things was the flood. And so every year the floods would come, and then people would get the support, but then you never change the issues. Why are you so vulnerable to the flood? So the lesson I learned from that early stage is it's much better to prevent your house from being flooded than it is to fix it once it's been flooded. So I think the same thing applies to the Treasury market. I gave a speech on that once, actually, because I think that's the right analogy. So it's much better to fix the Treasury markets. That's not my role or our role, but it's definitely something in discussion. On the other point, though, I do think it's possible to separate these market functioning issues from the balance sheet policy. And it's something that I think, frankly, just looking back for it, we could do a better job of over time, is just making sure the public is aware. We have done things in our communications, but making sure the public is aware and investors are aware that you can alter the balance sheet, shrink it or grow it for policy purposes, but you can also need to intervene. And the Bank of England's success in doing that, I think, proves the point that you can separate these things as long as you clearly, with truthfulness, point to why you're doing it at a particular point in time.
Okay. Other reactions from
Feel
the
free to
panel?
weigh in on the balance sheet.
yeah,
Everybody
yeah.
likes to talk about it.
Oh, no, I'm actually tired of talking about the balance
I am
sheet.
too, but that's okay.
I should just say that tomorrow Darryl Duffy is giving the keynote address on the
On the balance
appropriate
sheet?
size of the Fed's balance sheet. So
Oh, great.
if you are,
I want an exact
balance
number.
sheet junkies should
That's great.
show up.
No, I think, look, April 2nd to April 9th was such a hair on fire moment. But on April 2nd, at the end of the day, markets cleared. And it wasn't a liquidity event. But there was the question on investors' minds, what is the Fed going to do here? People were asking, was there going to be an SLR change imminently? And so, expectations were all over the map. And it was an extremely volatile time, and volatility equals uncertainty. The two are the same. I think, Mara, you mentioned long-term yields rising then, but they were rising for several different reasons. Also, during that week, the volume of President Trump's voice got louder and louder about firing the Fed chair. And, it's been many, many years that we've repeated over and over and over again that a president cannot fire the Fed chair. But what was happening at the time was that we were waiting for the Supreme Court to set a date for the decision on Humphrey's executor, which would have possibly opened up a backdoor channel to be able to fire the Fed chair. Now, when you think about U.S. exceptionalism, part of it is built on stable currency and independent monetary policy. And so you're threatening that independence, and so you could see it all over the market's face of exactly what that meant if the president were able to fire the Fed chair. Luckily, in June, the Supreme Court had made that decision, and they made a carve-out specifically for the Fed, recognizing how important monetary policy independence is. But that was part of what was also raising long-term yields at that time. And so it's oftentimes difficult to extricate exactly what's pushing long-term yields up. Clearly, it was Independence Day, and did I say Independence Day?
Unfortunately.
Liberation Day. We were all liberated from, I think the joke was I was liberated from my 401k on April 2nd. But But certainly it's that it was hard to extricate all the different things going on at that time that were raising longer term yields, and that's something that the Fed has to also deal with, trying to pick apart how much basis points can you attribute to everything that's pushing on yields.
Yeah, I mean, foreign yields were also rising. There was deliberation in the Congress about the budget bill. Also, notably, the dollar took a sharp dive downward, which raised, its own concerns, and that was not unrelated to the president's remarks about the Fed. But there were these concerns about market functioning, just given some of the ructions we had seen in the past. But it does point to the difficulty of looking at any particular market movement and saying, hey, it's because of this or that.
Maurice, may I add one thing else that you and Alan have just highlighted? The U.S. economy and the markets that did clear even during this period of high volatility are barely resilient, right? And so there's this tendency to think that we live in a world of fragility, but we've shown time and time again that is not the case. That doesn't mean you should pretend it's always going to be resilient. You have to watch. But I just think there's a tendency to think that everything that's volatile can create a problem, and it's actually not always true.
So I just wanted to jump in and say that, while I completely agree with all of that, I think it's also important to remember, and Maurice is an international economist, so probably has the same thought, that sometimes there are sovereign debt crises.
Oh, absolutely.
Sometimes people lose faith in a currency. Sometimes people lose faith in the commitment of a government to repay. Sometimes they lose faith in the commitment of the central bank to low and stable inflation. And I think for a long time, we've had the great benefit in the United States to be able to view all of those eventualities as essentially impossible. And what happened in the spring, and to some extent more recently also, these things are also continue to be very, very low probability, but I think the question has sort of been raised whether these are things that we need to think about, And again, there's some resemblance to some of the other historic events that we've been speaking about. That these are not things that we've needed to contemplate much in the past, but unusual things have been happening.
I would personally welcome a paper from the academic literatures or the research line where if you imagine, what if we go from something that's an impossibility to something that has even a small probability? What does it do to the sense of things, to the vulnerabilities, the fragilities, et cetera, that we've come to rely on, not having. So I just think of that as the very first thing I had to work on at the Fed when I started was the East Asian financial crisis. And I realized how disruptive things could be. I had to do a lot of studying on the international front, but I do think that's a good point, that we have to think about things that move from zero to some even small probability.
Well, we seem to be in a world where, tail risks seem to be popping up in various places that we thought were, very low or zero probability before. So I think that's a great research topic. Let me pivot to something else, which is a particular hobby horse of mine, and this is that what the markets do, what the Fed does, everything we do, everything we communicate depends on data. And my sense is that in the United States there is now in the past months less commitment on the part of the federal government to investing in high quality data, even a sense that data is just not important. And for a long time, the U.S. has been the gold standard for economic data. It's been, nobody has really come close. How do you see that data environment changing, the challenges for the Fed and the challenges for businesses and for markets?
Shall I
Yeah,
start?
I think you
Okay.
start every time.
Okay, let's just go, let's establish it as a rule. We're communicating it. So, the good policy gets made on the consistency of the information gathering, right? You learn early on, if you're an economist, a microeconomist in particular, that it's not that you're missing on things, it's that you get discontinuities in the misses, right? You can tolerate that we only have 70% of people filling out the surveys. It's only when it turns to 40% of the people filling out the surveys that you get very worried. So, because that creates a change that makes it very challenging to understand whether you have a signal or noise. The Michigan survey on inflation expectations just recently is a great example. They had some small survey change. It resulted in a big run-up in inflation expectations that we had to then unpack and see, is that signal, is that just noise? So those are really important things. So you think about some of the most long-standing collected information at a national level, whether it's on inflation or the labor market, well, then that is something that is a wake-up call about what do we need to do next. Now, we have an early start on this because the pandemic just got in the way of so much data collection. It reduced survey responses on several of our series. It changed the composition of who was responding, and the consequence of that is a myriad of other alternatives started to show up, but also we started to use them, I think, more effectively. So we have, if you look at the Federal Reserve Bank websites and across all the districts, and you also look at the board, you see that we do a lot of data collection that help us augment this. We also spend a lot of time, I think this is one of the strengths of the Federal Reserve System. We have these regional feds, and they're all over the country, and one of my jobs is to collect information from all of our contacts, businesses, communities, workers, that give us more information about what is going to happen. So I'm not going to pretend it isn't harder to do things well when series you've relied on are now not as reliable. But it isn't a signal that we should stop working. It's a signal that we should try to get other information. How would we do things if these surveys were not as available to us? What would we do? The way I think about it is don't get nervous about it, get busy about it. And how do you collect the information so you can reliably inform the policy decisions that we have to make 8 times a year?
So this is a topic that I'm also very, personally connected to, having worked with statistical agencies in various forms for many years. And I guess I would start by saying that I think it's a miracle that we have independent statistics the way we do in the United States and many developed countries today. We talked about truthfulness for the central bank. Those issues are just as severe, if not worse, when you think about agencies that have to report what the inflation number is and what the growth number is every month. And we look at countries around the world, and there are many countries around the world that don't benefit from being able to be truthful about those statistics, and that, of course, is incredibly costly for policymakers in those countries, because of course you can't make good policy when you don't actually know what the economic situation is. And right now, it is a frightening moment on this front. I think sometimes there's a perception that the private sector can replace government statistics, and having worked with a lot of price data over the years, this is absolutely not true when it comes to the consumer price index. It is also absolutely not true when it comes to labor statistics, which are the backbone to a lot of actually private sector data collection activities in terms of benchmarking and so on. So I think the fact that, for example, we've seen pretty substantial declines in data being collected recently at the Bureau of Labor Statistics for the inflation numbers is sort of scary. I don't think we know yet that this is sort of a catastrophic problem, but I think we do have to think about the sort of the canary in the coal mine, because if we actually lose the target, if we lose the number of inflation, then all of this, what is our rule, and flexible inflation targeting or not flexible inflation targeting, or are we, close to our goal, and flexibility and commitment, all that, it's all out the window. So I think that is very important, and again, something where I think we're not close to the precipice yet, but I think it's something where we really have to recognize that the system of independent and widely regarded, widely trusted economic statistics we have is not something that is taken for granted, and many countries don't have it. And we really need to avoid losing it.
So I do think that private sector data has really grown over time, and we are lucky because of that. We got a lot of practice during government shutdowns when there was no data being released by the government. And so in the private sector, we had to look at all kinds of privately generated sources to try to glean and fill that gap until the debt ceiling was resolved and the government was no longer shut down. And then we could pick up with all of the back data being released and sort of smooth over everything. And so that, in a bizarre way and a very dysfunctional way, helped us learn to use private data in a more robust way. However, it cannot fully replace the government sources. And I agree with Emi. It's just, I've always been proud of being an economist in the United States with the availability of data that we have. It just is unrivaled in other countries. It's been quite some time that the agencies have been losing funding. It's not just within the last year or two, although it certainly seems to have become more acute. Also with the offer of early retirements, I think talking with a lot of the data agencies, they were very surprised at the amount of mid-level employees that also took that option. And so you're losing a legacy of understanding and knowledge at agencies as well. I do think agencies need more funding, not less. And I think a lot more funding, because technology is ancient at the government level. It just tends to be. I started out working for government, and you have to get really crafty because there's little funding and technology tends to be so old. You've got to, maybe with upgrading technology, you can start to attract young talent to these jobs that aren't so attractive. You don't see a lot of Gen Zers jumping up and down, raising their hands, saying, I can't wait to work for government, for data agencies. But maybe if you've got more advanced technological capabilities and proper funding and stability, you can do that. There are data sets that concern me more than others. Emi, you mentioned plenty. I think it also scares me that we wouldn't have robust census taking anymore. A good deal of our thematic study of the US is based on knowing that you've got sound census numbers and census projections. How do we serve underserved communities if we don't have proper data from census? So I think it's something that we should all be concerned about. I think we should all give full-throated support to government funding of data agencies, and it's something that I'm a past president of the National Association for Business Economics, and we've taken a very strong stance on it in supporting the need for more funding for the data agencies.
Can I just add a final thing that links these things together that both Emi and Ellen referred to is that, we talked about how an independent central bank is extremely valuable. It's historical. It's across the globe that these things have been helpful. But independent data collection done by earnest people who have the public service view in mind is actually a strength of our economy, has been, or a strength of our society has been, and preserving that is something that I really think is critical. This independence of things that are about information and then policy making is a pillar of our society we don't want to leave behind. So I agree that full-throated support for the inputs to our processes, whether they're research or policy, is critical.
Okay, well, thank you. panel. On that note, I'm going to invite audience questions to Mary, Emi, or Ellen. We've got a mic there. So yeah, just come up. Well, Carolyn, you're close to a mic, and then I'll take you next. Remember, you're on candid camera.
Caroline Hawksby. I know all of you, or most of you. So I want to ask another communication question. And to back up a little bit, Mary, you obviously know that the FOMC depends on a very deep bank of researchers in the Fed and a very deep bank of research. And I was recently at a Stanford Institute for Economic Policy Research conference where there were many market participants, many of whom were economists, chief economists for investment firms. And one of the things we were talking about at my table and then afterwards during some of the conversation was how much they really loved attending research conferences with people, like people from the Fed or the World Bank or the IMF, because they said it really helps us with the spontaneous thinking. We can ask them spontaneous questions. We can get more inside their heads. We're reminded of first principles of economics. We have more of a sense of the depth of the economic research that is behind the sort of written reports that we're reading. So my question is, would it be a bridge too far to have more, say, Fed research conferences where there are more market participants, maybe not giving papers, but at least there for the conversation and the discussion?
Well, I don't think it's a bridge too far. In fact, at the San Francisco Fed and other Feds, we just did the conference that Atlanta Fed hosts, the Financial Markets Conference, and it was mostly market participants and then me and a few other economists. But I think in the San Francisco Fed, we've long done things where we've invited market participants. The Jackson Hole Conference hosted by the Kansas City Fed does that as well. I think these are strengths, right, for us. And it's partly a strength because you need research, but you also need practice. And you put those two things together. And, this is the same reason we have conferences where we bring, and we did this in our Fed Listens, where we bring community members and worker groups in. We have conferences with small businesses, medium-sized businesses, large businesses, because you have to understand what the models in your history tell you, but you also have to understand the lived experience and how the policy is being thought of. So I think it benefits the people we serve and market participants. The people you named are people we serve, and it's important, but it also benefits us. It adds to this idea that we have to be a little humble, or a lot humble, depending on the day, about what you can know from history and models and even empirical information. You have to actually ask more people. So I'm very supportive of it. If you can think of a place where especially we would be doing it, I'm always open to it. I know Ellen will walk away with a lot of ideas that you'll send me.
I'll be
about
there at each one.
Yeah, where to do it. But I do think you've really pointed to something important, which is doing things in an ivory tower that's just for us with academics is not the actual way to do our best work. Getting everyone involved makes what we do better. Thank you for the question.
Yeah. So I have maybe a little bit more lighthearted question is about the adjectives. And so Emi gave an example, right? Inflation at or moderately above, or moderately above. So moderate, modest, you know the list. So question to Ellen is, do you have a spreadsheet that lists the adjectives in the statement and translates them into 1 percentage point, right? 2 basis points.
I'd like to know that too, actually.
Yeah. and then to Mary, to me that seems like still the area where it's vagueness as opposed to flexibility. And is there any discussion of actually eliminating those and replacing them with numbers? So instead of moderate upside risks, saying there's risks of 0.5 percentage point on growth or something like that.
Yeah, it's a great question. I don't have a spreadsheet, but I do spend an inordinate amount of time on the phone with investors as they also try to work out, is modest greater than moderate? Is it, and we've come up with different answers at different times based on a feeling, because it's all very subjective. I'm always reminded of, it was one of the funniest moments, I thought, of one of Chair Yellen's early press conferences, where the Fed used the term a couple of months, she used, so there was something about a period of time in the statement. And they said, well, what does that mean? And she said, oh, probably a couple of months. And they said, well, how long is that? And she said, well, a couple. So 2? Maybe that's 2. And this underscores the general, challenge of flexibility, right? Because flexibility, you're not going to have exact answers. And guaranteed, if you asked modest versus moderate to all 19 FOMC participants, you're going to get a range of answers of what they think is the greatest or lesser than. The other thing that I rely on heavily, though, that's very helpful is on the Federal Reserve's website, the qualitative number assessments, I guess, that they give when writing the minutes. There's a ranking, because we used to have to rank that. And we would spend a lot of time on the phone ranking how much is several versus few versus many versus most versus a handful versus, it was said. That's one person, it sounds like. So, and so we do spend a lot of time on all of that. And I'm not sure that there's a whole lot more clarity that can be given around. What do you think? Modest versus moderate?
Okay, I will. I don't. So when I say this is not secrets of the temple. This is secrets of Mary. Okay, so here's my ranking: strong, solid, moderate, modest. Right? It's very clear. You don't put modest in front of moderate. Moderately. So one of the things that you'll notice if you're a very careful listener to the chair's press conferences is when he talks about restrictive monetary policy, he now says it's moderately or modestly restrictive. And what that means is to me, I'm not speaking for the chair, is you have some restrictiveness, it's imprecisely measured, and it's not 0, but it's not a lot. So that's ultimately what it is. So now, with the problem with probabilities, off the top of my head, is if we say 10% and 20% and 40% become the new modest moderately. So they say 10%, is 10% a lot or a little? Is it? So it's ultimately the real challenge is listeners want precision and we have none, right? We don't have precision, so we have to respond with somewhat, modest, moderately, and it is gradations. I think it's hard to figure out how to do that better, and so I'm going to come back to what I said when I talked about transparency. I think what people really want to understand is how we think. How we think. What do we, so it's less about modest and moderately, it's more about, I'll use this example. I think policy is restrictive. So the direction of change, if we felt the economy needed some accommodation or some less tightness, would be to lower the policy rate towards neutral. That's very different than the policy rate's at neutral and we would have to cut below neutral in order to get somewhere. So that's the level of explanation I think we can offer. And if you come back with a probability system that would solve our problems of modest, moderately, Ellen could let people in her team do other work. Because this is, and we could maybe use Gen AI, and somebody could come up with a list.
Yeah, we could just ask it and be done with it.
Yeah, there we go.
Hi, Mario Gonzalez from the Central Bank of Chile. I have a question regarding what's your take about the audience of communications of the central banks, what the audience should be. When we move from, as you mentioned, from the 90s that was very secretive, to now we enlarge the amount of communication and the clarity that we've spoken, but when we now in a place that we provide a lot of information, but it's mainly focused toward a very knowledgeable group of people. So how do we talk, or should we be talking to people that is not related to finance, not related to economics, and that's also related to a message that is someone that is not really knowledgeable in finance, comes in conflict with the clarity of the message. So giving a message that is clear also becomes more complex. When you talk about options or scenarios, it's not going to be as simple as to say, okay, we're going to have to be stay a lower bound for 14 months, for example, when you talk about that to an audience that is not knowledgeable. What's your take on those?
Sure, and I think one of the papers I mentioned, Yuri, his point was, his co-authors was, you can get a lot, other central banks have done this, you can get a lot out of communication by simplifying the message and then using other channels that different people than market watchers or Fed watchers and market participants would see. So I think there's been an ongoing attempt to do this, and I would point to 3 things that we're doing at the Fed that I think are part of the journey. Thing 1 is just recognizing that participants at the FOMC can talk to a wide variety of people. I don't think we should be unilaterally focused on market participants. That helps transmit monetary policy changes and it helps keep people informed, but the vast majority of the public don't have that market expertise or interest, and so finding other ways to communicate is important. So one way we do that is through our speeches, our fireside chats, the fact that we have Reserve Bank presidents and governors out in the communities talking to a wide variety of people. Part of it is, what audience do you choose? And then how do you go about talking with individuals in a way that reassures and builds trust? The second way that I think we're doing it now is that, I don't know how many of you watch these press conferences, but Chair Powell has completely moved to trying to speak in plain English. And you'll see at the top of the messaging at the press conference, in the opening remarks, there's always this statement about who we work for and what we're trying to do, and everything we do is for the benefit of the American people. That is part of what we're trying to convey. I'd also say that, let's go back to the episode where inflation soared. The critical message that myself and all other participants gave was not when we thought it would come down, but that we were resolute to bring it down. That's what 99% of people wanted to know, that we were going to do the work necessary to bring it down, that we weren't tolerating this, and this was not what we meant by flexible average inflation targeting. I think that was really important, and that we were not, complacent when we saw inflation get to 7%. That was not reaching our mark. And so you heard repeated numbers of us, and I think the most famous one is when Chair Powell gave his Jackson Hole speech, which was the shortest speech he had given in his tenure, and he basically had this message: we're resolute to bring inflation down, we will do what it takes to get it down, and nothing else is really on our minds right now. We are bringing that down. That changed how people thought about it, and it changed, I think, the sense that people had about things. So I would offer that it's not one simple thing, but it is the first you have to start with a recognition that all audiences matter. The second thing you have to do is recognize that the type of communication you offer should differ by the audience you're trying to reach. And the third one is, in the really tough moments, people want reassurance. We had a recognition of Ben Bernanke at the National American Economic Association conference, and one of the things that I remember so clearly is that Ben Bernanke was the first sitting chair to go on 60 Minutes. And he went on 60 Minutes not to tell people about the zero lower bound and all these things, but to reassure them that even though it looked calamitous, and it was, that he understood what was in front of us and that we were prepared to do what it takes to make the economy and their lives better.
Hi everyone, thank you so much for your great talk, and I just want to add more questions and a little bit more burden to you. My question is for Daly, and I forgot what I read, but I read this, I'm sure. The right decision at the wrong times become sometimes wrong decisions. and I'm relating with today's times. It's a very complex economic environment, and where the fiscal policies are frequently changing right now, and then addressing the emerging challenges in today's times, and how does the Federal Reserve communicate its monetary policy and decisions to uphold its dual mandate, especially understanding the potential trade-off. So this is my questions.
Sure, and I think I will return to communicating how we think about it. I would, you know, on your quote, the right decision at the wrong time ends up being the wrong decision, I would put it a little differently, if I may. I would put it as conveying a false sense of certainty or precision when we have none will almost always result in the wrong decision being conveyed, right? It's, you communicate well when you think well, and we think well when we recognize the uncertainty that we have, and then we just admit that, accept that. I mean, I'm going back to Emi's truthfulness, which you can see you made an impact on me, but there's a truthfulness to say that the world is quite uncertain, and we can't tell you with precision how it will evolve. Things are changing, but we can tell you with confidence that we are prepared for what emerges and that we are going to work to achieve our dual mandate goals for whatever economy we end up getting. And I think that's the thing that ultimately brings it back, because the right and wrong answer, we might not even know them, but we do know how to get there. And that, I think, sharing that thinking and sharing where we are confident in the future and knowing what the path is, and where we're not confident but we know exactly what the path is actually, back to the truthfulness, part of the transparency that we owe.
Okay.
Others want to say anything?
Is there one more question?
Hello, I'm Darius Martin from Western Washington University. And my question is, a lot of what you were saying about not tying yourself to the mast feels a little bit in conflict with what I was teaching my students about time and consistency in monetary policy. So I understand that, like monetary policy, your communications are effective only if they're credible. And what makes them credible is your willingness to implement what you say you're going to implement regardless of what happens. So I'm wondering if it's possible to add conditionality to your statements without undermining the effectiveness of your forward guidance.
Well, since you said tying yourself to the mast, I will turn to you first.
Yes, so I think, of course it's true that if you promise nothing about the future, then you're not committing at all. But it seems to me that saying that you're going to do something different if inflation reaches 5%, in an era, when nobody thought inflation was going to get anywhere close to 5%, is still promising a lot. So I think that the idea that if we want to promise anything, we have to have an ironclad promise to, not change at all, is maybe too much black and white and not enough shades of gray. Because there can be all kinds of conditional promises, and I think in models, those conditional promises will still have big effects. And I thought it was interesting, the last few answers, because when you were talking about simplicity, it made me think back to the question about adjectives. And when you responded to why the Fed didn't necessarily think of the fact that it said that it might behave differently if inflation rose moderately, you didn't say, well, people thought moderately might mean 5%. Some people thought moderately was 5%, because that doesn't seem reasonable. No, the reason wasn't that you hadn't actually included some of that detail. It was more that you felt like somehow the complexity of the statement actually meant that it wasn't all being acknowledged or absorbed, or
Or if we simply say, if we have a repeated clause that's not tied
right,
to...
the boilerplate isn't being read in some sense.
The boilerplates, I mean, most of us have rational inattention on boilerplate statements that come, and we don't read all the fine words, the fine print in contracts and other things. So I just think that it's almost like you're back to intentionality, back to thinking about what is it we're truly trying to convey. And I do think that if we do that, I know it actually works, because in my individual remarks when I'm out, this is how I talk about the world. If this, then that. If this other thing, then that. Right? If we get these black swan events, these low probability tail risk events, well, of course we would behave differently than if everything progresses as it has always progressed. So I think that's actually true. It's where we put it in the statement, and whether it's uniquely tailored to the situation we could face, or whether it's a boilerplate response. Like, I'll be home at 6 unless something else happens.
I think the earlier remark about emerging tail risks, new tail risks, is a real challenge for the standard dynamic consistency framework that
It is.
economists use in their models. And that's where your point about communicating, what you're trying to do, how you think about what you're trying to do, does provide some guidance and a kind of anchor for businesses and markets. And unfortunately, I think we're in a world where more and more tail risks are going to be emerging, like the one from last night. I think we have time for one more question.
Hello, everyone. I'm Bart from UNLV. Just a quick question, right? 'Cause we all know that we're going to live with the world of AI, right? So, would you consider the Fed incorporating the power of AI in doing your monetary policy projections? And that is all the questions. Rather than what we are, deep dependent on data and data latencies, as you mentioned, when the government shut down, and then how we incorporate AI into your monetary policy stance.
So I will say, from my vantage point, incorporating AI into monetary policy decisions is not something I'm thinking about. Where I'm thinking about AI is on how it will impact the economy. In fact, we have a center, in case you're interested in learning what we're learning about, the Economic Research, Emerging Tech Economic Research Network, and we're learning how AI is affecting the economy and how it's affecting things. And of course, best practices emerge there, such as you can use textual analysis, which economists have long done. This isn't brand new, but you can use textual analysis to understand what sentiment surveys are saying. You could probably use it to uncover the spreadsheet on moderately, modest, et cetera, over time that Galina asked about. So I think that's the way that you think about it, but using it to make decisions when we don't have yet even a sense of what we're supposed to be using it for in the back office operations, I think that's a bridge too far, and it would definitely not be something at the top of my mind. In fact, I would strongly suggest we don't do that at this point.
Okay, is that one more question? Okay, I think we can fit in 3 more minutes, so let's.
I spoke quickly, so you would have an opportunity.
Thank you. PK Jain from Memphis. So my question is that the Fed communication on cryptocurrencies, the stance has changed substantially from restrictive to very enabling now. So what's your opinion or take on how it will affect the unemployment and inflation?
So at this point, I'm just going to repeat what the chair has said on it again, is that obviously crypto markets are markets that we have to understand and follow, but we have no decision rights in these markets. And so our job is to understand them and imagine and think about how they're affecting the economy. The job of Congress, if you looked, the stablecoin bill is passing, and so those are the kinds of places where you think about this at the national level through our congressional leaders and the other agencies like SEC and things that are in charge of this.
Okay, well, let me thank President Daly and the panelists. I think this was just a fantastic discussion, and everyone's earned their lunch. So.
Thank you.